Hey folks, welcome to InTheMoneyStocks.com's free weekend daily analysis video, brought to you by the creators of proprietary price, pattern, and time methodology. Learn the PPT strategies and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, folks, into the action we go on this weekend's video edition. And number one, what we're looking at here is the SPY, which again is the S&P 500 tracking ETF. And you can see the last 5 days, so Monday, Tuesday, Wednesday, Thursday, and Friday's market action. Now, as you can see, early in the week, we were slowly increasing, going up very nicely, and then came Wednesday. And Wednesday was the pivotal day this week, and that's what I want to focus on in the beginning of this video to help you guys understand the importance of this day. So Wednesday, we all know the Federal Reserve came out and gave their FOMC statement in the early afternoon period, and the markets had a nice reversal. But the key to this day was the fact that you opened above the previous day high up here, and the high of the day was right here. Okay, so what we're going to do is we're going to draw a line there, and the low of the day was down here, which was lower than the previous Monday and Tuesday action. So again, do you guys see how the high of the day there and the low of the day on that Wednesday was eclipsing both the lows and the highs from Monday and Tuesday? Now, the reason why that's important is it puts in a little short-term pivot. All right, now again, the key to a short-term pivot in a market, whether it's to the downside or the upside, in this case possibly to the downside, is that following that you need to see confirmation. This is of the utmost importance. All right, now what is confirmation? Well, confirmation is a proprietary indicator we've developed here at InTheMoneyStocks.com. It's pretty simple, but ultimately people here at In The Money Stocks that are members, they know what it is. I can't really go into it too in-depth here, but I'll summarize it. Basically, it's confirming the breakdown reversal here of this low, okay? And again, one thing that I pointed to our members this week is that on Thursday we got below that low, but you never confirmed. Friday you got below that low as well, but you never confirmed it as well. All right, so this is the real interesting factor here, is that you have the pivot top in play. All right, so you have a potential. Basically, you'd put a big question mark over this day as a potential top, but we haven't confirmed it yet. And that's going to bring into the thesis of next week of what we're looking for. So you have two major things you're looking for next week is, number one, does the market trade up and take out this high? If we close above that high, then it is no longer a question mark. The market can go higher. All right, so I'm really trying to lay it out in simple terms for you guys who are just average investors looking to decipher what the market's telling you. All right, so that's number one. That's one possibility for next week. The second possibility would be is a close below the low here from that Wednesday. So basically you're looking at two things, a close above the high this coming week or a close below the low. And remember, we're talking a daily close here, not just intraday. Intraday we got, but intraday doesn't matter when you're talking about a potential daily pivot top, right? Well, I mean, we're looking at the intraday chart here, but this is ultimately whether we're putting in a major pivot top in the markets or not. So you have to look at the daily ultimately for a closing basis. So again, this coming week, at the end of any day, do we close above the high here at 177.51 on the spiders, or do we close below this low, which is around 175.65? So that is ultimately what you're looking for. And this is, again, going to let you know whether this market is in a breakdown mode or a breakout mode. All right, so can we go higher, or is this a potential top in the markets? All right, hopefully I laid that out very clearly for you guys here in understanding what's going on in the coming week. And again, there's a little bit more complexity to it, but again, that's reserved for members. Members know, based on the swing trade alerts we've given and so forth, what we're looking for ultimately in this market. Now, going into a couple other things. First of all, I want to congratulate members on a trade on JCPenney over the last week or so. Folks, again, just showing you guys what this trade was. I want to show it right here. We bought JCPenney on this date, on the 21st of October, right here. Okay? And we are our entry here in the Research Center. And again, Research Center at In The Money Stocks is geared towards investors. So if you're an investor, that's where you want to go. Swing trader, same thing, which is like an investor, just a little shorter time frame. But The point is, we bought JCPenney at $6.70, and I sold it on Friday at $8.10 for $1.35 gain. That's a 21% profit on JCPenney. So from basically entering it on this date, the 21st, selling on November 1st, clear and present 10-day hold period, locked in 21% profit. So again, just to give you an insight into what's going on in the research center, a great profit there for members. Going into a couple other charts, let's take a look at a couple different charts out there. Number one, let's go to JP Morgan's chart. We're going to look at the daily chart here. So JP Morgan's chart is hovering in the upper ranges, right? So I mean, if you look at the zoomed out chart here, you're definitely holding up here, but this is not the whole story of this chart. Okay, right now it's still holding in a strong position. However, if you want to follow a potential major breakdown, you do not have to go far to find it. All right, and again, all you need to do is take this low pivot, connect it through these recent low pivots. It also coincides with the 200 MA right there. This red line is the 200 moving average. If that line breaks, essentially if you close below this line, JP Morgan will be in breakdown mode. Okay, and again, you can see how many times we're hammering it. In spirit of touch, 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 and touch. If it comes down, again, let me rephrase this. As long as it stays above, this stock can float back up. First resistance is going to be up here. Second resistance, major resistance, is going to be double top up there. All right, so as long as it stays above the red line and this green line I put in, it could. It has the potential to go up. However, if it breaks below here and closes anywhere down here, okay, breakdown central, JP Morgan will head straight down to this area here, which again is around the 46.5 target range. So watch that very, very closely. All right. Next up, I want to bring in a new chart to take a look at, and that chart we're going to take a look at here. We're going to look at Amazon. All right, Amazon, a lot of hubbub about this stock after earnings. The stock gapped up. Right now, the stock is in an okay position because it's hovering. Essentially, take a look at this. If you take the opening level from the gap up on earnings and draw a line across, and you take the high level, you can even take the low and the high. We don't even need the opening level. Just take the low and the high right there. See how the low and the high, all of this action is integrated in between that low and the high? All right, so my point is this. Right now, this pattern is slightly bullish. All right, there's no denying it. Right now, it is slightly bullish. However, if at some point you close below this low of this first candle on earnings, which is around the 352.5 level, that will signal downside in the stock. Okay, so be clear on that. Right now, you're going to look at this and say, okay, this stock could go higher. If it ever closes at the end of a day below essentially 352.5, it should see continued downside. That would be a break of the pattern, a break of the gap up low level, and it would be a significant negative for the stock, at which point you can look for it to go down to this gap fill from prior earnings release. All right, very cool stuff there. Let's take a look at Apple. Last chart we'll go into today. All right, Apple continues to hover in the upper ranges in the 2013 period. And again, you can see right here you were in that upper range as well. Then you sold off, and now you've come back just underneath that. Now, right now, Apple actually has a bearish chart. Now, there's a couple small positives to this chart, but overall it is bearish. Make no mistake. Why is it bearish? Well, just take a look at this wide range bar on earnings. So earnings were released. The stock ended up opening higher the next day, and by the end of the day, it sold off. From the low of that candle, take a trend line and draw it across. From the high of that candle, okay, that engulfed all these candles. 1, 2, 3, 4, 5 trading days. It engulfed 100% of those candles. All right, since then, you've consolidated in the lower portions sideways. That's what we call an in spirit of bearish consolidation pattern. All right, ultimately, that chart, as long as it does not take out the high up here, is bearish, and you can look for downside in the coming weeks on Apple. All right, if at some point it takes out this high pivot here, again, we're ideally talking about a closing basis at the end of the day, then very simply, you just look for the high of the 2013 as your target, which is again at the 555 level. Okay? Now, again, as long as it's in this bar pattern, you have a very controlled risk-reward trade. Essentially, your stop out would be a high pivot close above right here, very simple. And any continued consolidation and any trading inside this wide range red bar should yield downside. Downside target right now, I have short term to the 50 MA, little pivot area right here as well. This is your short term target at 495. There's a secondary target that we should mention, which is right here at 478. All right, so again, 495, 478 downside targets inside the slightly bearish pattern on Apple here. Actually, it's more than slight, it's probably mid-level bearish. And again, any sort of close above the high here of 540 would be your stop out. So essentially, you're talking about a $20 stop for a potential of first target of $25, second target of around $35, $40. Okay? So not a bad risk-reward trade there on Apple. And again, this is just dissecting the charts. This is what we do here at InTheMoneyStocks.com. We utilize price pattern and time factors, which is called PPT methodology, and we utilize that to put us in the position of success, controlling our risk, maximizing our reward, and putting ourselves with an 80% success rate based on the PPT methodology. All right, folks. On that note, I'm going to bid you farewell. Again, remember what I talked about on the spiders. That's going to tell you exactly where the market's going to go in the coming week. You're just looking for one or the other to occur from that Wednesday high to low. And again, that should give us our short-term trend in the next week or two, depending on which way we go. Generally, I favor the downside slightly just because I think the markets are overbought, but ultimately it will be confirmed or not confirmed based on what we see early on Monday or Tuesday in this market. All right, guys, have a great afternoon, great evening, great weekend. Come join us here. Take the 7-day free trial, guys. 7-day free trial to the Research Center for Investor Swing Traders and the Intraday Stock Chat for day traders. Take care, guys.